Hello, and welcome to Crash Course. Today, we're diving into a topic that sounds incredibly adult and maybe a little boring, but I promise it's actually a fascinating story about community, risk, and how we humans have decided to deal with the universe's love for throwing curveballs. That topic is insurance. At its core, insurance is a simple, beautiful idea. It's a giant group hug for your finances. Imagine everyone in your town, or even your country, puts a little bit of money into a huge pot. You do it. Your neighbor does it. The person who makes your favorite pizza does it. Now, you all go about your lives hoping for the best. But life, as we know, is not always about the best. Sometimes things go spectacularly wrong. When one of those bad things happens to someone in the group, like their house gets struck by lightning and catches on fire, which is a real bummer. They don't have to face the devastating cost all by themselves. Instead, they can take money out of that giant pot to rebuild. The genius of this system is that while a house fire is catastrophic for one person, the cost is manageable when spread across thousands or even millions of people. It's a social pact. It's us saying to each other, "Hey, I've got your back if something terrible happens to you, and I trust you'll have my back if it happens to me." This collective safety net is what allows us to take risks like driving a car or owning a home without living in constant fear of financial ruin. Okay, so we've established that insurance is a giant pool of money for emergencies. But how do you formalize your membership? How do you know what's covered and what's not? That's where the policy comes in. An insurance policy is, quite simply, the contract. It's the official rule book that you and the insurance company both agree to follow. Like the terms and conditions you scroll past and click agree on. Except this time, read it. This document is the legally binding agreement that outlines every detail of your protection plan. It's the blueprint for your financial safety net, specifying exactly how it works. Let's use a more relatable example. Imagine you and your friends start a spilled drink on laptop fund. Everyone chips in $5 a month. The insurance policy would be the written rules you all agree on. Rule 1. Covers accidental spills during study sessions, not intentional dunks in the pool. Rule 2. Covers repair costs, not a brand new top-of-the-line upgrade. Rule 3. To get money, you must show everyone the sad, soggy laptop. The insurance policy is a much longer, legally fancier version of this. It spells out your responsibilities and the insurers with painstaking clarity. Verbal promises are unreliable. Without a written contract, there'd be endless arguments about what was agreed. Did the company promise to cover flood damage? Does your car insurance apply if your cousin from another country was driving? The policy eliminates ambiguity. It's the single source of truth. It protects you from a company changing its mind. It protects the company from fraudulent claims. It ensures the exchange is fair and transparent, even if the language reads like a 17th century lawyer wrote it. Now let's break down the most important parts of that policy, starting with the word you'll encounter most often, the premium. The premium is simply the amount of money you pay for your insurance policy. It's your regular contribution to that big collective pot we talked about. You can usually choose to pay it monthly, quarterly, semi-annually, annually. Think of it as a subscription fee, like for Netflix or Spotify. Instead of streaming movies or music, you're streaming financial peace of mind. This regular payment keeps your policy active. If you stop paying your premium, your coverage lapses and you're on your own again. So, how do insurance companies decide how much your premium should be? It's not a random number. They employ actuaries, basically math wizards, with charts and calculators. They analyze huge amounts of data to predict how likely you are to need money from the pot. For car insurance, they'll look at your age, your driving record, the type of car you drive, and where you live. Example, a 17-year-old brand new sports car, 2 speeding tickets, versus a 45-year-old perfect driving record, sensible minivan. It's not personal, it's just statistics, shared risk. But not everyone pays the same. Those who represent higher risk pay more. A smoker will pay more for life insurance. A home in a hurricane-prone area will have higher premiums. Paying a premium gets you coverage. But what does that even mean? Coverage refers to the specific things your insurance policy will actually pay for. This is arguably the most important section of your policy to understand. Just because you have car insurance doesn't mean it covers everything that could possibly happen to your car. Just because you have health insurance doesn't mean every medical procedure is paid for. The coverage section of your policy is the detailed list of protections you have purchased. It's the menu of bad events that the insurance company agrees to help you with, and it's essential to know what's on that menu. For example, a basic car insurance policy might only include liability coverage. This means if you cause an accident, it will pay for the other person's car repairs and their medical bills, up to a certain limit. But it won't pay a single penny to fix your own car. For that, you would need to have purchased collision coverage. And what if a tree falls on your car while it's parked, or it gets stolen? That requires comprehensive coverage. Each of these is a different type of coverage you can add to your policy, and each one adds to your premium. It's like ordering a pizza. The plain cheese is the base price, but every topping, pepperoni, mushrooms, collision coverage, costs extra. Every policy also has coverage limits, which is the maximum amount of money the insurance company will pay for a specific event. So, something bad has happened, and your insurance is going to cover it. Fantastic. But before the insurance company writes you a check, you'll likely have to deal with something called the deductible. The deductible is the amount you pay out of pocket before insurance starts paying. Think of it as your co-pay for a catastrophe. It's your share of the cost. Example: $1,000 deductible, $5,000 in damage. You pay the first $1,000, and the insurance company pays the remaining $4,000. Why do deductibles exist? They serve two main purposes. First, they help keep premiums lower for everyone. Deductibles discourage small, frequent claims. Without them, people might file claims for tiny scratches and dents. That would create tons of administrative work and drive up costs. The deductible filters out the small stuff and saves the pool for big losses. Second, deductibles give you skin in the game. Knowing you'll pay $500 or $1,000 makes you more careful. It promotes personal responsibility. You can usually choose your deductible amount. Higher deductible, lower monthly premium. Lower deductible, higher monthly premium. It's a trade-off. Predictable premium versus unpredictable deductible. Choosing the right deductible is a personal financial decision. Good strategy. Pick the highest deductible you can comfortably afford on short notice. It's your financial first aid kit for any claim you make. All right, the moment of truth has arrived. A baseball has shattered your living room window, or maybe you've had a fender bender in the school parking lot. An event has occurred that you believe is covered by your policy. Now what? Now you file a claim. A claim is your formal request to the insurance company to pay for something that your policy covers. It's you officially raising your hand. Hey, that thing we talked about? The bad thing? It happened. I need to access the big pot of money now, please. The process of filing and processing a claim is, honestly, the entire reason insurance exists. The first step is to notify your insurance company as soon as possible. Most companies have 24/7 hotlines or mobile apps to make this easy. You'll provide them with your policy number and tell them the basic facts of what happened: when, where, and how. This initial notification gets the ball rolling. The company will then assign a claims adjuster to your case. The adjuster's job is to investigate your claim to determine if it's covered by your policy, and, if so, how much the insurance company should pay. They are kind of like the detectives of the insurance world, gathering evidence to figure out the story. The adjuster will likely ask you for more information and documentation. For a car accident, this could mean a police report, photos of the damage, contact information for the other driver, and statements from any witnesses. Your job is to be as thorough and honest as possible. The more evidence you can provide to support your claim, the smoother the process will be. Once the adjuster has finished their investigation, they will make a decision. If approved, they subtract your deductible and issue payment so you can repair, rebuild, or replace, and get back on your feet. In many types of insurance, there's one more key player we need to talk about: the beneficiary. This term is most common in life insurance, but it can appear in other policies as well. A beneficiary is the person, people, or entity you designate to receive the payout from your insurance policy if you pass away. It's you from beyond the grave telling the insurance company, "Please give this money to my mom. Split this money between my 2 children. Give this money to my favorite charity that finds homes for retired racing greyhounds." It's a critically important decision. When you buy a life insurance policy, one of the most important things you'll do is name your beneficiary or beneficiaries. You can name a primary beneficiary who is first in line to receive the money. You can also name a contingent beneficiary, or a backup, who will receive the money if the primary beneficiary is no longer alive or cannot be located when the policy pays out. For example, you might name your spouse as the primary beneficiary and your children as the contingent beneficiaries. This ensures that the money goes where you intend it to go, no matter what. Why is this so important? Because if you don't name a beneficiary, or if your named beneficiary has already passed away, the insurance payout, known as the death benefit, goes to your estate. Your estate is basically all the stuff you owned. The money then has to go through a long, complicated, and often expensive legal process called probate. This can take months or even years, and legal fees can eat into the money. Naming a beneficiary allows the money to go directly to that person, bypassing probate entirely. It's faster, simpler, and private. Choosing and updating your beneficiary is a crucial part of managing your insurance. Life changes. People get married, they get divorced, they have children. It's essential to review your beneficiary designations every few years or after any major life event to make sure they still reflect your wishes. The beneficiary designation is your final instruction for your financial legacy, a last act of care for the people or causes you leave behind. So how does a person actually get one of these magical policies? Let's walk through the process with a fictional hero named Alex, who just bought their first car. Alex's journey begins with research. Alex knows driving without insurance is illegal and financially reckless, so they start by getting quotes. A quote is an estimate of what your premium will be. Alex goes online and visits websites of several insurance companies. On each site, Alex enters their age, enters their address, selects the car's make and model, enters their driving history, chooses the types of coverage they want. Alex decides on liability coverage to protect others. Alex chooses collision coverage to protect their car in crashes. Alex chooses comprehensive coverage to protect against non-collision losses. Alex plays with deductible amounts, noticing effects on price. A $1,000 deductible results in a lower monthly premium. A $500 deductible results in a higher monthly premium. Alex submits their information to 3 different companies. Company A quotes $180 per month. Company B quotes $165 per month. Company C quotes $200 per month. Alex is tempted to just go with Company B, the cheapest option, but then does a little more research, reading customer reviews about each company's claim service. After reading that Company B has a reputation for being difficult to deal with during claims, Alex decides to go with Company A. Alex then moves on to the application phase. This is more formal than the quote. Alex gives the insurer permission to verify information, like pulling their official driving record from the DMV. Once approved, Alex pays the first premium, prints the ID card, and is now insured, driving with confidence and a plan. So, we've journeyed through the sometimes confusing landscape of insurance. We've defined the abstract idea of a shared risk pool, demystified the policy, premium coverage, deductible claim beneficiary. It might seem like a lot of jargon and a lot of rules, and it is. But understanding these concepts is not just an academic exercise. It is one of the most practical and powerful life skills you can develop. Knowing how your insurance works is a fundamental part of adulting, right up there with knowing how to cook something other than instant noodles or how to do your own laundry without turning everything pink. Think about all the major milestones in life. Nearly all of these big, exciting steps involve risk, and therefore they involve insurance. Being able to confidently read a policy, compare quotes, and choose the right coverage for your needs will save you money and protect you from disaster. Ignoring your insurance policy is like signing a contract without reading it. You might be paying for coverage you don't need, or worse, you might think you're protected from something when you're not. The time to find out your homeowner's policy doesn't cover flood damage is before the flood, not after. The time to realize your health insurance has a massive deductible is before you get sick. Taking 10 minutes to understand the basics now can save you from years of financial hardship and regret later. It's a gift you give to your future self. Ultimately, insurance is a story about foresight and responsibility. It's about looking ahead, acknowledging that the world can be unpredictable, and taking smart, proactive steps to protect yourself and the people you care about. So the next time an insurance document lands in your hands, don't just file it away. Open it, read it, understand it. Your future self will thank you. Thanks for watching.